But let's talk about the markets right now, today, because that's all that matters. You can talk about the past and all that buying opportunities. Let's talk about where they are right now. Because if you're looking to find new ideas, companies with favorable risk rewards, it's freaking difficult. I mean, I would know. I've been doing this 25 years, cover all sectors, all stocks, and it's not easy right now. You're going to have to take on more risk, and you're probably going to get less reward because a lot of these names have moved higher tremendously. And you're looking at growth names early on in the cycle from the rebound in March did well. And again, they're off their highs a little bit because value names are on fire. Cyclicals are up huge over the past few months as our economy reopens. It's a great trade that we got into early. And we're not just talking about the economy reopening. We're talking about consensus estimates have this at GDP to grow 7% in 2021 and 4% in 2022. Now, what does that mean? GDP, the economy growing. I mean, you got to put in perspective. And you have to also throw in that we're coming off COVID. So we saw a big decline followed by, a couple of quarters of major declines and then a big uptick. But now we're looking at 7% this year and 4% next year. And if we put this in perspective, the last time the economy, our economy, U.S. economy, GDP grew 3% was 2005. And the last time our economy, GDP grew more than 4% was in 2000. So we're expecting 7% in 2021, 4% in 2022. That's incredible. And it should be easily attainable given that we ejected how much? $8 trillion into the system already? $8 trillion. How crazy is that? $8 trillion. Holy cow. With a T. Doesn't matter. Here's $1 trillion here, $1 trillion there. Everyone has their hands out. Politicians, everybody making money here. Handing out free checks. But the funny thing is, right, that's the past. Let's talk about now and into the future. Because Goldman Sachs came out and said, hey, okay, here's the $1.9 trillion. That's good to go. We're okay. People are getting their checks now. But now they said in September, there's going to be another $4 trillion of stimulus. And that's the number they put, another $4 trillion. What is it going to be, like 30, 35% of GDP now? So $2 trillion, $2.5 trillion is going to be dedicated to infrastructure. Again, this is a great report by Goldman Sachs they put out. But you're looking at all this money, and it's not going to be like the past stimulus package, where this is going to be more of a 5-10 year distribution and money allocated different things. So it's not going to see an immediate impact. But man, I mean, positives all around when you look at the macro backdrop. You see why everybody's so positive. We've been bullish for a very long time. And then you throw in the Fed, who was on not long ago, saying, okay, pedal to the metal, keep your short-term rates low forever. No problem there. And what do we have? Like, what's the biggest risk in the marketplace, at least being mentioned in financial media? It's rising long-term rates. We saw the 10-year surge to 1.7. It's around 1.6 today. It was, 1% in January, which is a major, major move, guys, if you don't follow this gauge. Major, major move. You don't really see it that much. Something like that big of a move in less than 3 months. Now, bond experts are calling for the 10-year to rise above 2% in the coming months and 3% by next year. And it's a concern. It's not a major risk. And I'm saying that because we look at our debt position of Frank's. I mean, the reason why it's not a major risk, guys, is because the Fed knows this risk. They see it coming. Our biggest risks in the marketplace are the ones we don't see, like the pandemic. I mean, dot-com bubble inflated incredibly high before it finally burst. I mean, people were calling that from 98 through 99 into 2000, and finally it burst. And then we had 2008, which was unexpected because no one knows how leveraged we actually really were. It wasn't just subprime loans. It was a leveraging of those subprime loans by 20x, 30x, which meant housing prices just had to decline a little bit and the whole entire financial system would break apart. And nobody knew what all this risk was. You eventually found out that AIG was up there and Fannie and Freddie and everybody got bailed out. But those are unforeseen things. We see it. We know this is a risk. We know how much debt we have. We see the numbers. So what does that mean? Well, it means the Fed could institute yield curve control to keep long-term rates capped. They did this in World War II to help fund the war. Japan's doing it now. But if you're looking at this particular risk, again, being mentioned on TV every day, a risk that the Fed sees, and it pushed stocks down initially, created some huge volatility, especially year to date. Just pull up a chart that's S&P or NASDAQ fell 6% in late January, rose to new highs, and then corrected close to 12% in February, and now it rebounded again. I mean, this is 2.5 months. Crazy. I mean, these massive, massive moves because we're at extreme valuations. We understand the economic backdrop is very, very favorable. But now you throw in that risk and it spooked people a little bit. But again, it's something we could see. And I've gotten questions saying, Frank, I don't understand. Like the large cap tech stocks, massive, great balance sheets. Why are they going to be hit the hardest, or they're being hit the hardest right now in a high interest rate environment? And I get that question. And you see, if you have a ton of money on your balance sheet, which a lot of these companies do, but they took out a lot of debt at dirt cheap prices. Even Apple, Microsoft, the companies, tens of billions, not hundreds of billions of dollars on the balance sheet. I mean, they could borrow for cheap, and they know they can make a much, much better return than that payment of basically 0 point whatever on your 40, 50-year bond, whatever it is. But if you have a lot of cash on your balance sheet, higher interest rates, you're going to earn a higher return, right? So I understand those questions of why is it hurting those sectors the most, of those stocks? But higher rates lead to what? It leads to less leverage. People aren't going to be able to borrow as much. And less leverage leads to customers of these tech giants. That's how they make their money. Their customers cutting their CapEx budgets. Everybody cuts back, which in turn results in a slowdown in sales growth and also a slowdown in earnings growth. And it's a big deal because many of these tech names, as you know, are priced for perfection. And the cheapest of the FANGs are trading at 30 times forward earnings. They used to be trading at 18 times forward earnings. And look at the premium on it, especially with Apple, who's not really growing as fast. Seeing a lot of these names, Google's starting to take off, outperformed. Facebook's still probably the cheapest out of the bunch, but these things are trading at very, very high valuations. And a lot of their customers will cut their budgets. They're not going to be as leveraged. They're not going to take on as more risk. And that's why you see some of those names get hurt, even though they do have great balance sheets. Because they're trading at inflated valuations because of their growth potential, and that growth potential is going to be cut. And then what else do we have? We have the reopen trade. Many of these names rebounded sharply. Big beneficiary of this trade is the cyclical names. We position our portfolios perfect. Got to a lot of these things early before the Russell 2000 took off. Russell 2000, I mean, companies under $1 billion in the Russell 2000, they're up 30% year to date. That's how crazy and how much they're outperforming. And it's mostly value. Who thought value cyclicals? We kind of nailed that like 3-4 months ago. I've been wrong on things. I've been wrong on Disney, but that was one of the things that we were right on. And, we position our portfolios accordingly. And a lot of people are doing well. We're up 80 to 120% on a lot of these positions over the past 5-6 months. And it's nice to see firms and everybody talking about them today as, hey, these are rebound plays and they're going to go higher. And we went a lot earlier. That's what people pay me for. And I'm glad. I want to see people make money. I don't get paid by companies. If I show you performance, you're going to continue to subscribe. If not, you cancel. So right now, everyone's doing pretty well about my portfolios. And again, that makes me happy. It's why I do this. Anyway, you're looking at some of these names that have rebounded. They're still trading. They might be trading at 52-week highs now. But remember, the market bottom or their high was in February. So they're going back to when the market crashed. So they're trading at 52-week highs, but they're still 15, 20, 25% off of their pre-COVID highs. And now they cut costs tremendously. They gotten money for free from the government. And now you see the reopen trade and all the stimulus and people have tons of money to spend. And you could see why. Financials, energy, casinos, airlines, consumer discretionary, retail, restaurants, and why these things are going to take off. And they have taken off. People have a ton of money to the tune of $2 trillion. It's 18% savings rate compared to normally it's an 11% savings rate. And they're dying to get out. They're dying to go on vacation. They're dying to spend money. They've been locked up in their homes. I told you last week how a lot of that is all bullshit, the COVID and political garbage. But hey, this is about stocks, about making money, and you're going to see these names continue to move higher. So how should you look at this market right now today? Because so many people are bullish, and you guys know I hate that. I hate that everyone is bullish now because you can't even find that. That's when you get to extremes. You're not really seeing any bears on TV right now saying, take your profits. Nobody's like that. I've seen that over the past 2-3 years all the way up. I don't see it at all right now, which makes me nervous. As you know, I said earlier, I've been bullish for a while, positioning portfolios accordingly. But right now, it's just finding those new ideas has become difficult. And there's 2 risks on the table of why that's happening. And I want to discuss with you right now because they're not being mentioned in the financial media. And it's important you understand this. So if you're watching, I'm going to share a couple of charts and figures with you guys on a Curzio, if you're watching this through Curzio Research YouTube page. If not, no worries. I'm going to explain it thoroughly. If you listen to iTunes, running, whatever, trying to get away from your wife or your husband for a little while, whatever you're doing. That's cool. But these two risks, let's go for the first one, is valuation. I know it sounds crazy. Valuation's never been a concern. The stocks that are moving higher are really the ones with the worst balance sheets. And the growth stocks aren't moving as high, right? So you're looking at valuation. Now, why do I say valuation? Because close to 70% of stocks are trading more than 20% higher than a 200-day moving average. And that's incredible. And I'm going to bring that up really quick. This way I could show you. So right now we're coming off the 10 best 12-month periods of small caps. This is the best ever out of the last 10. And small caps tend to take a pause, and this is according to Jeffrey's research. But pulling up that chart, record levels of stocks trading at 20% above their 200-day moving average. It's 70%. So if you look at the chart that I have up right now, if you look back at 2008, we went to about 50%, which is the highest since 1984. And you notice it was after 2008. So after the stocks get nailed, they rebound, and you see this. This is common. Same thing happened. There's a level at 2002, and you can see. And then dating back to 1996. But the average of these peaks is 40%. We're close to 70%. 70% of stocks trading 20% above their 200-day moving average. And when you look at that, that is insane. It means that you're going to take on an exceptional amount of risk because these stocks are higher, and your reward is probably not going to be as great. Why? Because these stocks have moved up tremendously already. And that's a scary environment, something you guys need to pay attention to. So valuation is a risk right now where these companies are trading. We're trading at all-time highs, and I get it. I get the backdrop. I've been pounded in your head with the Fed and interest rates low and trillions in stimulus. I know we've been talking about this for a very, very long time, and we position our portfolios perfectly. But when you look at this, and this is a great report going into small caps and just saying, hey, you know what, be a little careful, but they still see, positives. But I'm going to share another report with you, which I found was interesting. So the second risk is higher taxes. Goldman Sachs came out with a report. This is on March 19th, a few days ago. I'm showing it right now on my screen. Equity investors soon pivot their focus from rising interest rates to rising tax rates. Remember, Biden, they ran on higher taxes. These things are coming. But what's not really factored in is Goldman is saying that full implementation of Biden's tax plan will reduce S&P 500 earnings by 9%. So close to 10%. That's not being factored in right now. Not at all. And they're coming. Those high taxes have to come, and they're probably going to be a lot bigger and hurt tons of middle-class people because there's no revenue coming into these states right now. Especially you look at New York, California, who closed their borders, who said, we're taxing the shit at everyone who makes more than $1 million. Where do you think those people are going to go? They're flocking to Florida. They're going to Texas. They're going to more favorable tax places. And what does that mean? That's less revenue coming in. They have to raise taxes on the milk. They don't have a choice. They don't have a choice. They'll continue to happen. So these tax policies, they're going to be a lot crazier than even what they ran on. They have to be. But you go through this with Goldman Sachs, and they take surveys and everything. They showed, 10% decline, showing a lot of these. But they say equities do not appear to be pricing in much concern regarding tax hikes. They're not. And they go over, S&P 500 stocks, potentially that are vulnerable. I'm showing this list now. It's, Seagate, Microchip, NVIDIA, Xilinx, Garmin, Cooper Companies, Maxim, Integrated, Western Union, even Apple, Albemarle. These are all, low tax rates right now, but they're going to be raised considerably, which is going to hurt earnings. They show just different charts and different levels. And one of the things I liked about this report is they have market performance year to date, absolute versus risk-adjusted returns. And on top of that is Bitcoin. This is a Goldman Sachs report. Goldman is talking about Bitcoin, getting into Bitcoin now. They would have never listed Bitcoin as an asset class. This is Goldman. They're the biggest in the world. They have Bitcoin right up front. But when you look down this list, which is surprising for total returns year to date, the biggest underperformer is gold. Probably not a surprise there. But Russell 1000 growth, NASDAQ 100, utilities. So these are the areas that I want to look at right now to find new ideas. And I show how the cyclicals are outperforming tremendously. Defensive names are down tremendously. They just do a really good job highlighting lots of things. But consumer staples have underperformed. Healthcare has underperformed. Utilities, real estate has underperformed. Well, energy has rebounded, industrial rebounded, financials are on fire. So materials have rebounded sharply, but it's not easy to find cheap stocks, and that's where I'm getting at here. So, when we bring all this together, what does it mean? I ain't just throwing out numbers and throwing out stats, but you have two risks, which one is very hard to find good ideas because everything's trading exceptionally high. 70% of stocks, again, I'm repeating that because it bears repeating, which is insane, are trading, and it's the highest level ever, going back to 1984, probably back ever. But 70% of these names are trading more than 20% above the 200-day moving average, which is insane. That's insane. I mean, buying all these companies up here are pretty insane. And you have higher taxes coming, which nobody's talking about. Those are bigger risks than higher interest rates, only because we know higher interest rates are probably coming. We know that there's going to be inflation coming, and the Fed could adjust accordingly. It's a risk that they see on the table, but no one's really talking about taxes, and no one's really talking about how hard it is to really find new ideas because that risk reward is not as favorable. So, the 64,000 question, what should you do as an investor? What's the perfect strategy in this environment? Lucky for you, you have me and I'm a genius, and I'm always right 100% of the time. As you know, that's 100% not true. But here's, based on my experience of what you should be doing right now. Because that's all that matters now. Not in the past, not how much you're up, which a lot of you should be up a lot and doing well into bull market. But again, how do you position yourself going forward? And I suggest holding current positions, let those winners ride. And we have a lot of those in our portfolio. This rally could continue for many months. The backdrop is very favorable. But I'm looking at depressed sectors. If I'm looking to buy stuff like utilities, real estate, consumer staples, defense companies have gotten crushed. Insurance names have come down. But a lot of these sectors significantly underperformed. Just recommended a new gold stock and Curzio Venture Opportunities, which you're going to be getting today. If you haven't gotten it already, you'll get it pretty soon if you're listening to this. And that's, on the buy side, right? We could see this thing continue to go higher, and we want to be positioned. We want to be smart. I mean, I've seen so many people sell stocks too early, and you really don't know how high they can go, especially in certain market conditions like this. So definitely hold on. Not, giving you a dire scenario, we should sell everything. But how do you protect yourself? You could hedge yourself. I mean, buy a put on the Russell 2000, dated maybe 6 to 9 months out from now. Put 2 to 3% of your portfolio into it. So that means that's the money you're putting into that is the money that you will lose. And if you lose that and the Russell 2000 goes up, then you know what? The rest of your portfolio, again, this is how much money you have in small caps. The rest of your portfolio will take off and easily make up that difference. But if the Russell 2000 falls, that 3% position is probably going to be 10 to 15% because you're going to make a fortune on that trade. So you're risking 3%, big deal if you lose it. If you lose it, chances are you're easily going to make up that 3% because everything else in your portfolio is highly leveraged to the market and economic growth, regardless if you think it's not. It is. So much correlation these days. And also, the biggest thing here, guys, be mindful of your stops. Make sure you have an exit plan in case things get worse. Don't be stupid.